Good morning once again. We are back. Today's focus is on the dollar against the Canadian counterpart, and the setup is actually fascinating because it's technicals and macros that are aligned. Once again, this is typically what we're looking for. The dollar is strengthening, as you can see on the chart over here, and we'll see exactly why by blending the chart action and also with what's driving the move. It's potentially going to be beneficial. So the dollar has been moving higher over the past few months. Oil, sorry, dollar against the CAD, right? The oil has been moving lower, right? So crude oil has actually broken even below the 60 recently. It currently stays below the 60. Every time oil weakens, the Canadian dollar gets hurt because Canada, of course, is a commodity exporter. So when oil falls, CAD weakness follows naturally. If we see that bottom, for example, June 16, you will see that oil actually made a move on the 23rd. So just kind of then the 3rd of July, the USD CAD also kind of turned. Obviously, we have the USD at play as well. It's not really the correlation isn't always as high, but it is what it is. Now, let's talk a little bit about the Fed. The Fed is moving a bit more cautiously, right? So it obviously affects the dollar on rate cuts. While some officials see December as a reasonable time for a 25 basis point cut reduction, given the labor market expectations for the labor market to be actually existing data have been shown weakness in the labor market, and we're expecting perhaps even this Friday the NFP to come out. It might be also weak, but it was just going to be half of the data anyway. No unemployment, but the key point to remember is that the Fed isn't rushing to cut. Okay, a patient Fed typically supports USD strength because investors can hold dollars and earn a decent carry while waiting for clarity as well, right? So let's just go back to just the singular chart over here. USD CAD. I am looking for use the card for themselves as long as the Fed remains, of course, it's sort of it's hold its recent stand to not really rush with December cuts. We're going to see how that pans out anyway. What I am currently seeing here, right, is a potential inverse head and shoulders pattern, and a potential continuation from the breakout point. So if we take the 135.36 to the 139.96, let's call it 140, this is the distance of the neckline from the head to the neckline. And we pull this just at the front over here of this breakout point of the neckline at 138.94. That brings us up to 143.64. Okay, so price also just retested the 139.87 while also kind of resetting halfway through that trend, right? Because we're looking at this trend to the upside. The RSI hasn't really fallen much lower than the 50 line on the daily for a long time. And we're looking at a retest and a reset of momentum for potential continuation. Why is this level important? This level is important because it goes all the way back to the previous 2022 resistance. And obviously, it's caused, it was broken over here, retest. We had this lower leg to the downside. We kind of saw a similar reaction here. Falls break initially, pull back, and then we're seeing prices moving higher, creating a new swing low above that resistance. So that resistance now has become support. And this has, of course, become very important level to keep an eye on. So we do have some sort of divergence over here on the RSI, okay? And that's why we saw that leg to the downside. But for now, we're not looking at any sort of direction following that. So the RSI remains above the 50. It means that the bias remains to the upside. That also means while we are above that level, the bias remains to the upside. Okay, so the measured move, where does it bring us? It brings us, well, of course, we need to break 141.45 first, and then we're looking at 143.63. Before that, we also look, this level is quite important because we had previous support that has become a resistance. The next leg to the upside will likely be somewhere around 142.50 or so because we have high activity over here. And then we're looking at this particular leg, right? So what validates this move? If we clear 141, 45, 50 or so, precisely, it signals the breakout is real and we'll be looking at the completion of the measured move. The RSI has also room to run above 60, okay, before any overbought signal becomes concerning. So you see, currently we are sitting at around 53. So even another leg to the upside currently up, it would be possible. The key is that, of course, as I was just saying earlier, that oil remains below 60, I would say, or perhaps it could maybe just like fluctuate around that level, but as long as it's around that territory, then USD CAD could go higher. What would kill this particular opportunity? I would say a daily close below 139.90. Okay, that would not necessarily invalidate the pattern. The invalidation of the pattern would be down at the right shoulder, which is around 137.20. But we would be looking at a extension down to 138.85 if we lost that level, and that would then increase the chances of a consolidation, right? And it would be obviously naturally creating also a potential the potential environment, forming the potential environment for further downside. So, bottom line, this is a medium term sort of trade in my mind where both technicals and fundamentals are pointing for now to the same direction. Weak oil environment supports USD strength, the Fed is patient, and the inverse head and shoulders pattern opens the door to 173. 60 70. So I will be using the 139.85 as the line in the sand. Target initially 141.42, 145, then 143, 42.50, and then of course let that run to the rest with a trailing stop, and manage also around the levels as we head into year end because we have like a few weeks for 25 to end. So that's your USD CAD analysis from Thinkmarkets, trade the structure, respect the macro backdrop, and we'll catch you next time.